Hi, everybody. Thomas Morgan here with 1031navigator.com. This is a listener Q&A episode of the 1031 Exchange Passive Income and Investment Series. You can ask your own question at 1031navigator.com/ask. Today's question comes from a caller in New York, and the question is about zero cash flow properties, also known as ZCFs or zeros.
Hi, I want to know if we need to be Series 7 licensed to sell the zero cash return properties, the 1031 exchange. I think, do you need a Series 7 to sell these properties? I'm a realtor. I want to get into selling these properties. I have quite a few clients. So please, if you could answer this question. Thank you.
So the question seems to ask more about licensing than an actual zero cash flow deal, but will give me a good opportunity to explain some of the nuances of zero cash flow deals. But basically, if you're asking about licensing, you of course should check with your local and state boards regarding licensing. But in my experience, what you're referring to is a Series 7 license, which is actually a securities license for stocks, bonds, equities, stuff like that. But no, I don't think you need a Series 7, and the reason being, and like I said, check with your licensing authority, but the reason I say I don't think you need that is a zero cash flow property is a property. So if you wanted to sell the property, you would most likely need a real estate license in the state where you're selling the property at. Most zero cash flow deals are typically CVSs in today's market. There are a few Walgreens. I've seen some other, maybe a couple Dollar Generals. And I've seen some big office and industrial buildings structured as zero cash flow deals. But basically, when you're selling a zero cash flow deal, you're selling the real estate. So one, I think you need a real estate license. And two, if you're placing zero cash flow financing, which is pretty advanced financing, even then, I don't think you need a Series 7 license. But you basically would need a mortgage broker license to do that. If you were, syndicating money or trying to be a broker dealer to actually sell portions of equity or debt on the property, then maybe a securities license would be applicable. But that's, again, beyond my scope. But basically, anybody out there listening who doesn't know what a zero cash flow property is it's essentially that, a property that produces zero cash flow. And the way these are typically structured is they do a fully amortizing loan on the property, or what's also known as a self-liquidating loan. And at the end of the lease and the end of the loan, you own the property free and clear. The loan is self-liquidating, so it pays itself off over the term of the loan. And what they also do in these deals is and that's where the zero cash flow comes from, is they match the rent payments to the P&I payments. And the tenants work in conjunction with the people who are structuring these deals so that the rent or the NOI in the lease equals the P&I payment in the loan. And therefore, it's a zero cash flow deal to the investor. People invest in zero cash flow deals because it's a low equity amount. A lot of zero cash flow deals you can get in for 5%, 10% equity, or maybe up to 20% equity, depending on the deal. So that's as opposed to like a 50 or 60% LTV, which is normal in the triple net lease space. So if you're coming from a 1031 exchange and you have a low amount of equity, but you have a big amount of debt you need to replace, zero cash flow deals work for those types of situations. There's a lot of advanced tax planning that goes into buying a zero cash flow deal, and I don't really recommend buying one unless you've spoken at length to a pretty sophisticated CPA and or tax attorney. In my experience, zero cash flow deals are bought by high net worth investors who are looking for the high depreciation write-offs and the high interest deductions. But the main reason people buy them is the low equity amount in a 1031, and they can also buy them for what's called a pay down readvance, where you can actually, depending on the zero cash flow structure, you can actually match the amount of equity you need to replace to the amount of debt you need to replace. So if you sold a property for $10 million and you had $1.5 million of equity, and for some reason you had a big loan of the 8.5, you could actually match the debt and equity exactly in a zero cash flow. You pay down the existing loan, and then you readvance it back to yourself. And again, that's a little bit more advanced tax planning, but that's just an example of another reason why people buy those. And then the last reason people buy them is to own a property free and clear at the end of the lease. However, I think there's other types of investments you can buy and ways to finance them, to own a property free and clear at the end of the lease. One is you have to put more equity into a property. For example, I just did a Dollar General in Ohio where it was a 50% loan to value, 14 years left on the lease, and my client did a 14-year self-liquidating mortgage on the deal, and he'll own the property free and clear at the end of the lease. Yes, it will eat into his current cash flow, but he thought that worked better, and he was able to get a super low interest rate, like mid 4% interest rate, a little above 4% interest rate on that loan to do a amortization over 14 years, and then he'll own that free and clear. And as a side note, most of the zero cash flows in the marketplace today are typically CVS's. You'll see a few Walgreens that are zero cash flows, maybe a Dollar General or two. And then you'll also see some really big offerings, might be $100 million syndication of an office building or an industrial building where they have placed zero cash flow financing on it, and they allow investors to buy portions of that $100 million property to meet their 1031 guidelines and requirements. And if you've ever seen what's called a rent holiday deal or a CVS advertised with a rent holiday, these are essentially zero cash flow deals that have been paid off or will be paid off at closing. The way a lot of the CVS zero cash flow deals were structured is instead of amortizing the loan over 25 years, they amortize it over 22 years. So essentially the main loan is paid off in 22 years, but then they give CVS 3 years of free rent. They essentially front load the rent to help pay that 23-year amortization off. And then CVS gets 3 free years of rent, which is the rent holiday. So if you've seen a rent holiday deal in the marketplace, that is a result of a zero cash flow financing deal that was paid off at some point in the past or will be paid off at closing. And we could do a whole nother episode on rent holiday deals and the way brokers advertise them and try and get rent holiday deals done. But basically, in my opinion, rent holiday deals don't really make sense unless you're buying at a super high cap rate, because your property is essentially tied up for 3 years with no income on it. And there's different ways to do a time value of money calculation and net present value calculations on that. But it's kind of financial engineering, in my opinion. But hopefully that answers your question regarding the licensing and gives you a little overview on zero cash flow transactions. That does it for today's listener question. Hopefully you got some real value out of that. To ask your own commercial and investment real estate question related to 1031 exchanges and or triple net properties or other passive income real estate, please visit 1031navigator.com/ask. Again, that's 1031navigator.com 1031exchange.com/ask. You can also leave a question by leaving a direct voicemail at the podcast hotline 970-300-1994. Again, ask your question by leaving a voicemail at 970-300-1994. Thanks for listening to the 1031 Exchange Passive Income and Investment Series. Hopefully it's helping you create, build, and protect your wealth. Talk to you soon.
And remember, this show is provided for your informational and educational purposes only. Be sure to check with your accountant, lawyer, and or other tax professionals and advisors before relying on this information. Although the information contained herein is believed to be accurate and reliable, we do not guarantee its accuracy or completeness, and it is provided without warranty. Common sense is the best practice.